Speaking of momentum, we certainly saw the broader markets in rally mode today, despite the coronavirus concerns. For perspective on where we go from here, let's now bring in Kevin Headland. He's a senior investment strategist at Manulife Investment Management. Kevin, good to catch up with you. Thank you. So give us your top-down view in terms of where you were expecting 2020 to be and what your updated view is.
We've been actually defensive since mid-2019. I think as we saw valuation peaking midsummer and then essentially it's a bit higher since then. But fundamentals have been selling off. You look at PMIs or purchasing managers indices have been falling down, exports falling down globally. As the data was getting weaker, we figured the valuation would eventually come down. Of course, it didn't. We've, I think, surprised the upside. We're up 30% for 2019. And again, as we roll through 2020, we had expected the same thing. So right now, valuation at high levels, near 22 times trailing on the S&P 500. Now we're seeing what's going to crack it. We haven't seen anything cracks yet. Coronavirus, perhaps, is it? Is it election? Is it risks of Iran war, which we haven't seen for 3 weeks?
Yeah.
Where's that crack going to come from?
Well, what if it doesn't?
It couldn't. Markets could grind higher. Momentum begets momentum. But I think as you see valuation, the expectation for earnings gets more built in. And if we don't see earnings pick up, we've seen some pretty good beats on certain names, Disney one of them, but others have massively disappointed and they've sold off. If we get some disappointment on a broad base, valuation should come back in line with earnings expectations.
It seems as though with the phase one China-U.S. deal that that we've actually really seen the global PMIs flatten out, bottom out here, to the point where yesterday we actually saw expansion territory for U.S. manufacturing that nobody was really expecting. Factory orders today in the United States also look a little bit better. So why not be in the camp that says, you know what, we've seen the worst? And
that's very possible. I think it's possible we have seen the worst. You know, looking globally, especially in Europe, we've seen a bottoming. Now do we see a reacceleration? Or is it just a bottoming? Is no longer that bad mean that good yet? So it's still something to look at. Have we passed the point? There's still some uncertainty. Phase two is still to come. That's going to be pushed off till after the election, I imagine. I don't think they get done before election. But there's still some uncertainty out there. We'd perhaps want to be more conservative in kind of the show me, is that data real? Is that ISM data we saw, you said the big beat, going to continue? Or is that a blip in the market, a blip for 1 month? That's still to be seen. Let's keep looking forward to see the data come through.
So from a strategy perspective, then, how are you recommending investors weight their portfolio?
So we have a 60-40 base portfolio right now. As I said, we've been 50-50 since mid last year. Obviously a bit more defensive, but still participating in areas of fixed income that still give you some upside in the market, such as high yield. We are a bit more defensive, not chasing numbers or chasing names and sectors or geography, but still making sure we participate in the upside, just in case. If you don't meet the market or even beat the market in the upside, but you do protect on days that you're down, overall you're going to compound greater and you'll outperform over a longer period of time.
So what's the best way to do that then, in terms of protecting the downside right now?
Right now it's about looking at defensive names, defensive companies, companies that protect you better on the downside, but again, still participating. We still want growth, we still want earnings growth, but also measuring the value you're paying for that growth going forward and not chasing growth if it might not be there. That drop from a higher valuation is going to hurt you more over time.
So let's be specific from a geographic perspective. So in Canada, what are you doing with the Canadian market?
So Canadian, we're going to be defensive. We're looking for games that are just growing. Perhaps they're more multinational, still access the perhaps the U.S. growth. Canadian economy is still, looks like it's starting to struggle now. Perhaps we want names as much levered to the Canadian consumer or economy. But looking at specific names where we have opportunities, we are more top-down, so we let the portfolio managers choose the best names that they feel right for their portfolios. But we try and be more looking for managers who are more defensive in nature over their history.
What does that mean, though, in terms of owning the Canadian banks, as an example?
So Canadian banks, attractive valuation, extremely cheap, nice dividend yield. But where's that growth going to come from? Are they going to be able to generate loan growth? Most recent quarter, they announced more loan loss provisions. Now, of course, that's not losses, but more loan loss provisions. You have to keep more capital on the sidelines. So that could hurt perhaps their growth going forward, but still very attractive from a yield perspective. So what are you looking for? Are you looking for just core and steady Eddie performance, or do you want to actually get growth?
But what do you think? Like, how much, when we're talking about risk to the downside, what areas within Canada are you concerned about to the downside?
Looking at, Canada doesn't have as much downside perhaps as the U.S.
Okay.
Looking at valuation, how it trades relative to its long-term history, it looks actually fairly attractive. Looks attractive relative to how it trades against the U.S. over long-term history. So Canada actually from a valuation perspective looks attractive. it might not be growing as fast as perhaps the U.S. might look at perhaps the next year or two.
And then we were talking a little bit about, I was talking about tech anyway. What do you think about the overvalued areas in, I don't know if you're looking at Canada for that front. It doesn't sound like
not as
or
much
the
because they're
US.
smaller, but yeah, the U.S. overvalued is a tough term because again, these companies still produce great growth and are even beating some expectations. What are you willing to pay for that value? Also, how are you measuring it? Is it a discounted cash flow model? Is it price to earnings ratio? What metric do you ascribe to choose what you should grow? And if tech is growing that much faster than other sectors, perhaps you're willing to pay up a little bit more for that growth than you would in other sectors.
So what are you guys doing with U.S. tech?
Right now, again, we're more broad-based. We have actually embraced portfolio managers who are underweight technology because, again, we're looking for those cracks in the foundation where you might get a bit of downside risk because valuation is getting to that level where perhaps it's fully valued, not stretched yet overall, but fully valued, I'd say.
Okay, Kim, we'll leave it there. Good to see you.
Thank you very much.
Thanks. That's Kevin Headland, Senior Investment Strategist at Manulife Investment Management.